IBM, ticker symbol IBM, is currently trading at $232.20 a share, up almost 43% from the start of the year. Is this the right time to buy? Well, they have their earnings on the 23rd of October, and there has been a lot of buzz around the stock. They have unveiled new versions of their Granite 3 AI models for businesses, and this stock has been doing very well. Actually broke its all-time highs. If we go to the max chart here, they were previously at all-time highs back in 2012 at 185, and this stock has blown through that to 232. So let's just have a look at my automated stock valuation spreadsheet. We're going to be looking at the company's financials to see if it is a buy or a sell. And what we're going to be doing is looking at the discounted free cash flow model, comparable company model, dividend discount model, and of course the Ben Graham formula for intrinsic value. So IBM, market cap 213 billion, PE of 25.59, and this is lower than the market average, which is around about 29 to 30. Earnings per share $9.07 and a 0.7 beta, meaning it is less volatile than the market. Analysts saying, interestingly, it is not a buy with a target price of around about $209 a share. Now, this is a favorite among dividend investors, 2.88%, meaning if you were to buy this, you would get around $6.69 per per share over the course of the year. They pay around $2.6 billion, and the net income payout ratio is 75%, but the free cash flow payout ratio is only 46%. And if you want to get paid some of this dividend, buy before the 9th of November, as that is the ex-dividend day. So let's have a look at the revenues of the company. Trailing 12 months, 62.07 billion. Now, not the all-time highs you can see here back in 2011 and 2018. And then they had a big drop off here, but in the last 5 years since 2019, this is sort of breaking new ground. They are expanding and growing, and 62 billion up from 2023. Net income, we are seeing a similar story again. Most profitable it has been in quite a few years, almost breaching those 2018 numbers with 8.81 billion in the trailing 12 months. So the last 5 years is looking good. Free cash flow, they are generating lots of free cash flow, 13.14 billion. This means the dividend is very safe, as you can see, and has increased since 2021. Not back in the 2020 numbers when it was 15 billion, but you can see here it's been pretty consistent, but growing in the last 5 years after a bit of a dip. If we look at the operating cash flow, CapEx is actually down here. This is the red line. It has been decreasing, but operating cash flow is up and up and up, which is the blue, which is meaning free cash flow in the green is up. Shares outstanding as well. They were previously buying back shares pretty consistently, but they have been issuing more shares in the last few years. So let's have a look at my discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. Based on averages, it's putting around about $600 stocks. So let's have a deeper look at the numbers here and see why. Revenue, we're expecting around about 64 billion in the coming years. Let's just have a look and see if that is close to what analysts are saying. And they're estimating 66 billion. So what we'll do is we'll be a bit more bullish on the revenue numbers here. Bring that up to about 3.5%. Net income margins, I think that we're actually on the lower side. Net income has increased. Let me just take an average of these, which is probably in the region of about 11%. $700 stock, but I think the reason here is because of these free cash flow net income. I think the 2022 number really skews this. So let's bring it down to the trailing 12-month value of 160. Actually, we'll go in the middle. We'll go 150. $339 a share. So discounted free cash flow model does really like this stock as they're generating more and more free cash flow. And $300 a share. So pretty bullish actually, but still it does kind of prove the cash flow generation of IBM. Before we continue, please like and subscribe and all that fun stuff, and check out my Patreon as well, where you can get this sheet. So we'll quickly jump on to the dividend discount model. You can see here that they do have quite small growth since 2021. They had a big jump up in 2020, but now it is about 0.16%, 61%, and weighted average cost of capital 6.3%. So if we take the average of that, Yeah, see, so intrinsic value on this is somewhere in the region of $115, even if the discount rate was higher, which would be bad. If they were to grow at about, yeah, you'd see really 3.5%, then it would be fairly valued. But they are doing small dividend increases, which is what people like. We'll quickly look at the Ben Graham formula for intrinsic value. This was created by the godfather of value investing himself, Ben Graham. Looks at earnings per share, PE of growth companies, AAA bonds, and currently I believe the AAA bond yield is still 4.68%. And analysts are expecting growth over the next 5 years of around about 4.5%. But you can see negative growth in the last 5 years, and they're expecting positive growth again, so that is good. Is it a buy? I'm going to say no. $100 a share. So really, for Ben Graham to buy, it would have to be somewhere in the region of 20% over the next 5 years. So that's quite high estimates. So Ben Graham doesn't like it, dividend discount model doesn't like it, and the discount free cash flow does love it. So finally, we'll look at the comparable company model. This is where valuing companies looking at similar businesses of similar sizes, similar industries, looking at the revenue, growth rates, EBITDA, net income, profit margins, price to sales, price to book, PEG, which is price to earnings growth, EV to revenue, EV to EBITDA, PE, forward PE. So competitors that I think sort of jump out immediately, one of the closest ones I would say was Oracle, ticker OCL. And what this will do is it'll load all the latest company financial data for those companies so we can have a little comparison. I also think Microsoft, obviously a lot bigger, but I do think it is a fair comparison. And I'm going to go with Intel as well, INTC. Very broad range here of companies, but you know they do work in a lot of similar stuff here. So enterprise value, you can see that Microsoft's the biggest with about 3 trillion, Oracle 560, IBM half the size, and Intel half the size once again. Revenues, IBM is second highest in revenue, 62 billion. 54,233 from Microsoft, that's massive, and Intel 55. Growth rates, 5-year growth rates, obviously a bit all over the place here. Intel decreasing, Microsoft increasing 14%, Oracle increasing. But as we went before here, you can see that obviously this is back here in these numbers where it was 80 million. But they have been growing at a very small rate, I would say. So revenue has been growing over the 4-year averages, for example. EBITDA, 14, 21, 1, 2, 9, 10. Net income, it is the third most. Microsoft 86 billion with 36% profit margins, Oracle with 11 and 20%, IBM good with 13, and Intel not very good with 1. Price to sales, price to book. The averages of the price to sales on the S&P is currently 3.06, which is slightly higher than, and price to book 5.15, so higher again. PEG, price to earnings growth. You can see Intel is actually the best according to Peter Lynch's, which would be less than 1. Oracle and Microsoft pretty neck and neck, and this is the highest. So now we have the multiples here: EV to revenue, EV to EBITDA, PE, and forward PE. Now in terms of PE, it is, well, we'll look at these first. Second lowest in EV to revenue, EV to EBITDA looking pretty good as well. So $400 and $200 a share in that. PE ratio actually the lowest, and also on the forward PE ratio lower than all again. So this puts it at sort of an average share price at $375. Apologies for the Teams notifications. So discount free cash flow model likes it, comparable company likes it, dividend and Ben Graham formula not so much. So yeah, right guys, thanks for watching. Please give a like on the video, check out my Patreon, like, subscribe, all that fun stuff, and I'll catch you guys next time.